going into an accelerator with a very defined goal and then measuring what success looks like in that accelerator are giant ways to win. You can show traction, you can show that you're winning, you can show that you're coachable, you can have success in the accelerator, and then it's awfully nice when they come back and say, wow, you're crushing it. Now you're going to go raise your Series Seed and you're going to raise $2 million and I've got half of that or whatever it might be. You don't want a 4-month accelerator, you want a 10-year relationship.
Welcome to the latest episode of Raise&Exit podcast. And I have a question for you. What do you do when you've been a multi-time founder, you've had some exits, you've gone internationally to raise an accelerator, then sell it, then you go and encounter a whole bunch of different crazy deals. What is next in your life? Well, for that, we have Bob Gillespie to go and give you the pathway for your future. Bob, welcome to the show. Please build on what I just started with as to why you have the cap table expert in the background. Please tell us a bit about yourself and what you're up to these days.
Will do. Thanks, Edgar. Thanks for having me, man. As you mentioned, a 3-time founder. Then I got into the investment side of things. I ran an accelerator in Turkey, of all places. Then I came back to the U.S., ran an accelerator there. We got purchased by a venture fund where I'm still at. I manage about 70 investments. But one thing that I really enjoy, I'm a kind of a quant head. I'm kind of a math dork, to be honest. And through my network, I just started to run across a lot of earlier stage stuff that were having massive problems with cap tables. I find that information out there is okay, but it's confusing and lawyers will charge you an arm and a leg. And quite honestly, I think a lot of times they don't even do it properly. I've been doing cap table work for probably 15 years. And finally just went out and decided to put my stamp. I'm actually captableexpert.com. This says the captableexpert.com. And literally have worked with hundreds of companies on all things equity structures, cap tables. And we can get into some of the wackiness that happens. But it's one of the most fun things that I do, I think, is work with a wide array of startups and hearing their ideas and, kind of getting them to the next step, in particular in a professional, constructive fashion, where they have the underpinnings of success in their structure. Because if you don't have that, it's really hard to be successful when your kind of, underpinnings of your structure are not good.
Well, I think it's great, and I appreciate that kind of more color that you went in out of that, Bob. And I think not only are you going and having this experience from looking at so many deals, but you're having to manage it with these investments as well. So in the spirit of our show, which is really around knowledge transfer and giving you insight that is months or years in advance, I'm going to go and start with an extremely basic question. When do you not need to worry about a cap table? Under what conditions does it not matter, if there's even a situation like that, for somebody looking to raise or sell their business?
I would say once you exited and the check is in the bank and you distributed the funds, and then you can tear up your cap table. But other than that, you better know that thing, and it better be a living, breathing document. I don't think that cap tables are something that you kind of build up front and they go in a drawer. I'm always kind of horrified when I get to somebody and I'm like, hey, where's your cap table? And they're like, well, I kind of got to put it together. I'm like, I don't know what that means, that you got to put it together. Like, this should be every time something happens, it goes into the document and the documents go into a folder. And that folder ties to all the supporting documents.
It's like backfilling your corporate minutes. Oh, yeah. We got together 4 years ago on the anniversary of founding the company. That's right.
Yes, it is. And rolling it back, it's bad enough when you have the historic documents, but it's even worse when you're doing things like, well, did we give Edgar some options? I don't remember. Did we sign it? I think we have a document that says that he has. This is a fun one, Edgar. We have a document that says that we gave Edgar 2%. Don't ever do this. We have a document that says Edgar gets 2% in options, but we never signed it. And I don't remember if we have a wet signature, but I can't find it.
You're getting into legalese. A verbal contract's a contract, and a contract that's verbal is a contract.
And now let's say that later on you raise some money and that 2% was supposedly diluted by the new money. Now, Edgar comes and waves a document at you and says, I didn't get diluted because my document says 2%.
Yeah.
So percentages are dangerous. There's all kinds of things that when you go try to reconstruct what happened to you in the past, it's very problematic. And when you do that, guess who loses?
Yeah.
company.
I think what you're pointing to, Bob, is I think one of the big challenges that is there, and I really want to kind of emphasize this for our viewers and listeners. This is not like I have never started a company before, and this is like a problem in my first few months or years. I have gone and worked with companies that are over 2 decades old that have inane cap table issues on them that ultimately impair the transaction because they need to be deconstructed. And I think, Bob, to what you're going and pointing to is you always need to be able to understand who owns your business if there's a transaction, which is different from who owns your business as it is. So
Right.
can you kind of add a little bit to that on the ownership of the business as it is versus what the cap table facilitates because of trigger clauses, right? Changing control provisions, exercising warrants. Like, what are some things that people should be thinking about well in advance when they even start structuring the share capital of their business that they may not just think about?
Yeah, let's talk. Let's just take a really easy base structure of, it's me and you, Edgar. We start a company, and we decided we're going to create 1 million shares. That's a nice little number of shares. And well, you're a little smarter than me, Edgar, so we're going to give you 51%. So you got 510,000 shares, and I got 490,000 shares, right? All right, great. And maybe in our operating agreement it says that. Hopefully it says that. But also, do we have a share issuance agreement that says that Edgar has 510,000? Do we have that document? And then did we file our 83B election if it vests? Because we should be vesting. And then that should all be sitting in the
Hold on,
cap
I'm going to interrupt you right there, Bob, because you just said something that is so much missed by people, which is shares at issue or registration of the corporation versus share that you grow into, right? There is a vesting period. And some founders, they just go and give shares to everybody at the beginning. But then there's actually shares that are there, especially in a multi-founder situation, right?
Yes.
You got to stick around or you got to hit certain milestones for you to go and get that. So apologies for the interruption, Bob, but I think that's a critical piece in a multi-founder company. And we're not even talking about investors yet. We're just talking about more than one founder that is there. So back to you, Bob.
Yep. So let's say that, and Edgar, you and I are friends. But let's say that I did this with my brother. Let's say that my 2 brothers. Me and my 2 brothers decided a company to create a company. I would do this with my brothers. Okay, guys, you and I, Steve and Scott and me, we're going to create a company, and we're all going to own a third, and it's all we're in on this together, and we have the best intentions, and we own a third, and a third. And we decide that we just give each other those third, because we're brothers. Nobody's going to leave. Nobody's going to do anything. And then all of a sudden, one of the brothers, I don't know, his wife gets a job in China. I don't know what happens. And now he's like, hey, guys, I can't do this anymore. I have to move to China. But I own the third of the company. Great. Go get him. Go get him, fellas. And we're like, well, hold on a second. We're doing all the work. Are you going to give us some shares back? And also, let's say you take an investor and then they give those shares back. They don't give them to me and my brother. That goes back into the company. So now the investor's share also goes up by their pro rata. That causes problems. So what you should be doing, what everybody should be doing, is when you create a company with other people in particular, that I would recommend that you say, okay, we own a third. Great. And they're going to vest over 3 years. Let's make it relatively easy. That's 36 months. So what we might say is we're going to test drive each other for 6 months. You got to stick around 6 months. That's called a cliff before you own any of it. If we all get through the first 6 months, then now, while our name is on the ledger that we own a third, we only have true claim to 1/6 of that 33.33%. Then perhaps every quarter or every month, I kind of like every month, we get 1/30 of the remaining. That then takes us all the way to the end. So I'm
going to come back in on that one, Bob, because I think we are in an era of AI-aided development of companies where that monthly cadence, I think, is crucial. I would say you could even start making an argument where you may need to look at things from a weekly or a cumulative, like hours or share of time allocation contributed as informing that. And like this thing is blowing up like crazy. Like look at Lovable, look at Cursor. These are all both companies that are less than a year old, have gone and raised hundreds of millions of dollars and multi-billion-dollar valuations. And if they did it right, and we don't know, but if they did it right, they would be going and having this vesting schedule be micro-monitored. because there's so much valuation change between Monday and Friday, when almost any publicly listed or private equity owned company or a private one, I would probably say you could probably do it on a monthly cycle.
And what you can do too, Edgar, the downside of not doing vesting, and I see it all the time, is in one of these where they just explode in value, that one of them could just say, great, bye guys, I own a third. It's written down on a piece of paper.
I'm out.
And it's called dead equity, dead, DEAD equity. And now I own a third. And you want to come and tell me that I don't own it? Well, I have a piece of paper that says I do. And I didn't have to vest. The minute that I signed it, I owned it because it's a contract. So if you don't vest, you're leaving yourself open to all kinds of problems of a founder decided to take a powder for whatever reason and walking away with a giant chunk of equity. So what you would do is here's another piece that gets missed, Edgar, is not only are they there, let's say you're only there for a year out of the 3, when they leave and they haven't vested those 2 years, you're going to buy back that equity at the initial purchase price, which means that it was nothing. You do not have to go to that person and say, well, you didn't invest 2/3 of it, but now we have to buy 2/3 of the, hundreds of millions of dollars of value, because that's what your stock issuance agreement is going to say. Yeah. So vesting, I would say there's probably 4 giant things that I see that are massive problems. So, but dead equity on a cap table because of lack of vesting is one of the most common problems that I see.
Yeah, that I think is so valuable. And there's a whole other aside. I'm not going to go in there too much, but I think if you could just add a little bit of color, because one is around ownership, and I think another one that is a lot missed in these structures is voting rights, right? So you can be on the cap table without voting rights that is vesting, versus you go and have maybe a different class of shares that has the voting rights. And then they have non-equity value, but they have voting or directionality of the business. And I think that's another one that I notice is really missed by a lot of organizations, is how do you handle decision making? Do you use the traditional directorship model, which is very hard to facilitate early stage in companies, and I would even say in later organizations. So anything you just want to quickly add on that point before I want to kind of shift the conversation to another aspect of your background and expertise?
Certainly. I mean, I think that, let's make it easy. I'm not a big fan of this. I'm not a big fan of I own common class A shares and you own common class B common shares and you don't vote and I do. Not a big fan of that.
So you're not a fan of the Snapchat model where investors own nothing and the founders get to call all the shots and change the structure anytime they want.
Well, I mean, I think any negotiation is going to be, there's 2 components. There's a financial component and there's a control component, right? That's going to be a negotiated setting. I think that sometimes founders give up equity when they should have given up options. So I think that most founders, when they create their company, should be carving out an option pool of, say, 10 to 20%. And then that is where they're going to carve that out. And then they're going to give that to early hires, to advisors, to board members, to people that can help them. But it doesn't clutter your cap table up because they're not shares. They have the option. Hey, it's called an option. That's a good idea. It's called an option for a reason. They have the option to buy a share in the future at a price we're going to set today. So if the stock is worth a 1 cent a share, we're going to write down Edgar has the ability to buy 100,000 shares for a penny in the future, but we're going to lock in the price today.
I remember going through that with one of the companies that I'm involved in. Is I went and got it at I think 1/2 of 1/100th of a penny, or something like that, and I got 500,000 shares for $1,000 when I exercised them.
Yep. Now I don't want to go down the rabbit hole, but now you're going to make me do it, Edgar.
Shoot! What have I done? The path to hell is paved with good intentions.
Well, here we go. I'm speaking from the founder standpoint. Let's say that I give somebody 100,000 shares, and early on, I, in my opinion, make the mistake of issuing those at the par value of the stock at the time. So let's just for fun say your par value is 0.001. Let's just say that for fun. And I issue you 100,000 shares. I'm sorry, 100,000 options at the strike price, the exercise price of 0.001. Now think about that. When you fully vest, Edgar, it's going to cost you $100 to turn those into shares.
Yeah.
You're always going to write a $100,000 check and take the chance that that's going to be something. But as a founder, I don't want you cluttering up my cap table. If you're going to come in and write me that check, I want you to have to put some skin in the game to turn them into shares, Because once your shares, options, we're maybe engaged, maybe. When you're a shareholder, we're married now. So what I would be doing is I might say our founder shares have a par value of 0.001, do our 83B election. By the way, anybody listening here, if you don't know vesting an 83B election, you might want to email somebody like me to help you through that. And then when you set your strike price, throw out another industry term, you're using a 409A valuation. That's going to set the fair market value of your common shares. You want to make that a fair market value where, for example, in my earlier discussion, Edgar, you and I had 1 million shares each. And I don't get out of bed unless I'm working on something that I think in my head, with my knowledge base, with your knowledge base, with our experience, you and I could have a board meeting and set the fair market value of our company to be $500,000.
Yeah.
Picking a number. Now, if I take 1 million shares, $500,000, that means that each share fair market value is worth 50 cents. Then we go and we issue the 100,000 shares at a 50-cent strike price. Now that guy's got, when he vests, he has a big decision to make on, do I want to write a decent sized check in this company to actually take an equity stake in it? So that's something that gets missed a lot, is giving away these par value warrant or par value options, because you're going to clutter up your cap table, because who's not going to write you a $100 check?
I think there is so much in here, Bob, that I think can be like a whole like educational series.
I can bore you to death. I've already got all the talks, my friend.
Oh, beautiful. Okay, perfect. So, folks, you want to learn more, go to Bob's site. The link's below. But I think that part is so critical, because if you look at the composition of most founders, even people that are like in that like ideal range of founding a company, which I think somebody went and did like this longitudinal study, and like 45 to 52 or something was like the ideal highest success rate of being a founder or something like that. I know we romanticize the 21-year-old who dropped out of Stanford or Harvard or something like that. But the point that I'm trying to get to is there's so much you need to know to run a business. Like the way I kind of describe it is like being a founder, you have to become a master of many. It's not a jack of all trades, master of none. You have to become a master of many, because then you got to figure out how you delegate it to other people. And I think one area a lot of people just mess up on is like, oh, I went and registered a company, I got myself 100 shares issued, blah, 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 blah. Oh, now I need investors. Well, crap, you've already got a problem that you've gone down the road of just because you tried to keep things simple. And I think that kind of like if you're going to go down the path of having multiple founders or having future investors or shareholders in your business, regardless of how you get there, I think, capology is something you need to be able to go and figure out for yourself. And I'm totally picking a team from fantasy sports in cap league tables, but it's the same thing for your business. Like, I don't think people really kind of appreciate that aspect of it. So I'm going to go and bring in an intersection of your past with the theme of today, which is around the cap table. And I would love for you to go and give some perspective on accelerators. You've gone and launched one. They participate in investments differently. So how does an investor that is, maybe, working inside an accelerator space, or, has some money lined up, but they need a lead investor before the accelerator is going to cut a check. Give me a sense of how do you balance expectations from an accelerator when you're an earlier stage company, and then how do you manage that from the equity that they get access to?
Yeah, I think, accelerators has become a bit of a cottage industry. I'll give you some opinion on this as well. I
like opinions. It's going to be pointed.
If I was a founder and I was leading accelerators, I think that there's, like in any business, there's some charlatans out there that are out there to try to get, some equity, and they are going to put you through some curriculum and, what kind of value they bring. And I think that, there's also very different stages of accelerators. There's incubator level accelerators that are like kind of, MBA or startup 101. We're going to talk about your ideal customer profile. We're going to talk about your tech stack. We're going to talk about your sales, your go-to-market strategy. We're going to talk about your drip campaign, your top of funnel. We're going to talk about kind of the startup. There's that. Then there's accelerators that are kind of you've maybe got a thing built and now you need to get to the next stage. Yeah. And then there's more late stage accelerators where I play, which is more of I'm not even sure if I work at an accelerator anymore. I think I work at a scale up. I think what we are is you have an idea, you built a thing, you got some traction. Now it's time to pour some gasoline on the fire and really scale it up. So a couple things that I would think about if I was a startup looking at accelerators. One, I would think, regardless of which stage you are, I would think very defined. What are the 2 or 3 things that I want to accomplish in the accelerator? Like defined goals, not, well, we're going to go through, we're going to get some mentorship, and we're going to get some money, and we're going to get some connects. No. I would like to get an expert on go-to-market strategy. I would like help with business development and fundraising. Or we're starting to scale it up, and I need help on hiring operational help. Or here's another one. We had a founder leave, and our cap table is janky, and this accelerator seems like they can help us with that kind of stuff. I think that all of that is really helpful, but I think going into an accelerator with a very defined goal and then measuring what success looks like in that accelerator are giant ways to win. Because I think a lot of people go through an accelerator and get to the end and they're like, well, we had a good time. We met some people, but I can't put my finger on what we did. We have one company that went through one of my programs, and she's unbelievable. And she will monthly, she reports to me, here's how much MRR, because she went through us for biz dev. Here's how much MRR that I can directly attribute to your program. I mean, unbelievable that you can do that. So I think that's a big piece. And then just understanding, is this an early stage accelerator or a later stage accelerator? What am I getting? What does their curriculum look like? What kind of value do they think they bring? And then, and this is just one guy talking, I think a lot of times, there's a reason Techstars, the Reach Accelerator, I think there's a reason that those accelerators are, world class. And here's why they're world class. You not only get their accelerator capital and their program, but if you can find one that also has a follow-on fund on top of that, then you can develop the relationship. You can show traction. You can show that you're winning. You can show that you're coachable. You can have success in the accelerator. And then it's awfully nice when they come back and say, wow, you're crushing it. Now you're going to go raise your Series Seed and you're going to raise $2 million, and I've got, half of that or whatever it might be. I think that can be a massive positive out of an accelerator. They have the ability to get in deeper with you. I think that you probably don't want an accelerator that says, we have a graduation, we do a demo day at the Marriott, and we invest, we have local investors come and we have some cheese and some shitty wine. And then let us know if somebody invested in you, and good luck. Go get them, kid. I think that's sort of you want an accelerator that is, this is what I say. You don't want a 4-month accelerator. You want a 10-year relationship.
Oh, that's such a great statement that I think you've just got to put there, because I think, I look at some of the previous guests that we've gone and had on the show, and they really espouse about like being an A team in terms of who they want to invest into. What I also look at it is you got to be able to figure out like what type of a team you are, but you should also be able to then go and command great investments. And I think the point of accelerators is there as well. Now, I joked previously about the path to hell is paved with good intentions, but I actually want to kind of wrap up our session with each other around that, because I think that there's so much cleanup of messes that come there from a good intentions point of view. So could you go through a couple of kind of like these sound like well-intended ways that you've structured the business, or you've set up the dynamic with a co-founder or with an early investor that just it gets you to cap table hell? What are some early warning signs that you can share from some of your experience so that people can catch themselves and avoid making a mistake that some of the folks have gone and done?
So we talked about this before, and I'm going to use the word now, but if you're going to take $1 from somebody, okay, you got to be a fucking professional, okay? And that to me is like, I'll look at something and like, you're not a professional. You didn't do this like a professional. You took money that somebody earned and you jacked around with it. And I'm not saying you're not putting effort forth in your business, but I'm saying you didn't understand the structure that you took that money in under. I'll give you 2 things where sort of the road to hell is paved with good intentions. One is, boy, my team, I really want to incentivize them. So, Sarah, I'm going to give you some options. And that's a good thing to do, incentivize your team. But then you had good intentions, but you didn't document it. You didn't create an option pool. You didn't create an option document. You didn't do any of the things that you need to do to be a professional to issue equity to people, or options, the promise of equity. Now think about Sarah. That's her life, man. That's her money. You're messing with her money and you didn't write it down. We don't do that as a professional. So I think that's one thing, is just not documenting things, not putting things in folders, not getting signatures, not having your stuff super, super tight. And then the other thing that I think that happens is I'm going to go get some money, some friends and family, and they're friends and family, and I want to be good to them. So a safe is sort of the down the fairway, well constructed vehicle now to take early stage money. Mm-hmm. Now, if this was 2008 and you came to me and said, Bob, I raised some money and it's got this goofy structure and we probably got to redo it because I didn't know what I was doing. Okay, it was 2008. All this stuff wasn't kind of already created. We didn't have sort of the path that the animals have walked down a million times.
Yeah.
Right? Now the animals have done that. We've walked down the path a million times. We know what structures work. We know the holes. We know the problems in the structures. We have the structure now professionally as an industry called a post-money safe note. We can argue post-money safe note, pre-money safe note, convertible debt note. I could argue it till you cry. But I think what early stage investors might do is say, well, my uncle, who's a dentist who does pretty good, came to me and we wanted to cut him a really good deal because he was giving us some money. And so we took a document, but then we put in this other thing. And then now on Tuesdays, I have to wear a shirt with a kitten on it. And then on Thursday, we have to buy pizza and send it to his thing. And then I got to wear a hat that's blue. And they put on all this crap in a document. And then let's pretend that even though you did that, you took your uncle's money and then you made a success out of it. You did something good. And now you come to a guy like me or some other professional investor, and now they want to put $1 million in your company. And they go, hey, show me what you got. And you go, yeah, I have to wear a shirt with a cat on Tuesdays. Yeah. And he has an interest rate. And he gets to convert at this. And for every first dollar that I make, he gets 40 cents on the dollar until he's paid all the crap that happens that should never happen. And then here's what that investor says. One of two things. Goodbye. Or call your uncle and tell him all this shit's coming out. Out.
I think this is so good. I love what you're pointing to is not only should you have a very clear understanding of your cap table, what I'm actually having as a takeaway from this conversation with you, Bob, is you should be able to pro forma any investment vehicle very clearly. And it's also an articulation of, are you getting legitimate money coming back to you? Are you getting professional funds coming to you, whether from an angel or an accelerator or an incubator or a Series A, that they are also able to cleanly articulate, this is what it's going to look like on the other side of my check to you. Like that's just like, it's just hitting me right there.
Yeah, here's what I would do, Edgar, if I was a startup, and it's a couple hours of work with a professional, is say, does my cap table right now with just my common shareholders look good? Do I have an option pool that's reasonable?
Yeah.
Here's some safes that I've already taken. Let's model those out. And then let's also model them out on an as converted basis. So what's it going to look like when it converts? And then let's put in scenarios. What if it converts at a $6 million valuation? What if it converts at an $8 million valuation? What if it converts at a $10 million valuation? What if we take $1 million? What if we take $2 million? What if we take $3 million? What if when we take that new money that the investor says that they want us to increase our option pool because we need to hire a chief sales officer? All that sounds really complicated, but It's not. It's a couple hours of work, and now you have this incredible living, breathing tool. And then here's the great secret. When you go to raise the money, a lot of people don't have as good of information as you do on your cap table. So when they say, I want to give you an example, I want to give you $2 million on an 8, and I want you to have a 10% option pool. And you say, actually, I think we're worth 10. So I would like 2 on a 10, but I'm willing to give you a little larger option pool. And they might say, yeah, that sounds pretty good. If you know what you're doing, you know the number. And now maybe, it says this right behind me, because every point matters. Yeah. That's when you can be like, oh, by making a trade-off and understanding it better than everybody else, I got out the door and I own 56% instead of 53%. And you can start to do that when you've got things modeled out and you understand it. It's really, Edgar, this isn't that hard. I'll brag. I think I'm one of the top couple hundred people probably in the world at this.
Well, Bob, this is why we appreciate having you here.
Yeah, I don't think it's hard. I think it's detailed and nuanced. And if you can just understand it reasonably well, you're way ahead of the game and also turns you into a professional. I think a lot of people are entrepreneurs. They want to be an entrepreneur.
Oh, man. Do we have a title right here? Bob,
I don't know who said that yours. I stole that from somebody.
Either way, though, I think you're onto it. Bob, I'm so thankful to you for being the spirit of our podcast and that knowledge transfer. Look, I would say for anybody listening or watching, and you're hooked by this conversation, you want to set yourself up for just avoiding a lot of hassle, avoiding losing a lot of investors or money in the future. Go to captableexpert.com, pick up on what Bob has got and share that. Bob, thank you for joining us today. This has been an exceptional added value to our listeners and viewers.
Super fun, Edgar, man. And also, if you go to my website, like I'm really not here to pimp out my wares. I'm really not. I do coach. I do free sessions all the time. Here's what I want people to do. Don't be an entrepreneur, be an entrepreneur. If I can help you, great. If you always want to go to my website and check stuff out, if you want to check out ChatGPT, I think that's all fantastic. What I want people to be is be a professional entrepreneur. This is kind of a new thing, right? The last maybe 20 years, so many entrepreneurs. I think that I can call myself one. I started my first company in 2001, and I love to bump up against other true professionals. There's a kinship there, and I think that the world's a better place when we're all sort of doing the right thing together.
That's beautiful, Bob. Thank you so much. Have a good one.
Thanks, Fred.